This is Horizon's Middle East and Africa. Our top stories this morning. A US tariff reprieve for Canada and Mexico pushes Asian markets higher. The two nations promising tougher measures on migration and drug trafficking in exchange for a 30-day delay on President Trump's 25% levies. Attention now turning to China with a threatened 10% tariff due to come into force today. The White House says Trump may speak directly with President Xi. And Israeli Prime Minister Benjamin Netanyahu is set to meet with President Trump in Washington. He's the first world leader to visit the White House since Trump's inauguration. It's just gone 3 p.m. here in Sydney, 8 a.m. across the Emirates. I'm Paul Allen covering for Jemima Bisteche. Let's take a look at how markets are tracking at the moment. A fair bit of interesting activity in the bond space at the moment. We're seeing the 10-year yield just continuing to creep up. But they've got the 2s10 spread at the moment, sort of hovering around the 30 basis point level. So it is, in fact, the Bloomberg question of the day. In fact, if that yield curve will invert again, there are, of course, some concerns over inflation and growth and, of course, the tariff story weighing on treasuries as well. And the tariff story is weighing on pretty much everything you see on your screen there. We have seen the oil price backing off a little bit after President Trump delayed the imposition of tariffs on Mexico and Canada by a month. However, Europe could be next, and we're seeing the euro right now at 103.14. So the question again turning to whether or not we will see parity on that currency pair. We haven't seen that since way back in November 2022. S&P futures also liking the news that tariffs have been delayed. They're showing a little bit of upside by about a 0.1%, but we've seen some pretty decent moves in Asia as well, reversing a lot of the losses that we saw yesterday. So let's check in on how markets in Asia are faring. Avril Hong's in our Singapore studio. Avril.
Yeah, Paul, absolutely. Today we're seeing that reversal in the selling of a day ago in Asia stocks and currencies. Some now calling yesterday's moves an overreaction. Stocks rallying hard, led by Hong Kong, and the idea that after Canada, Mexico got that reprieve on tariffs, that China could follow suit, get the same, dependent on what we hear from Trump and see maybe a phone call underway. But worth highlighting as well, when you look at the Hang Seng Tech, it's actually paired the gains of about 5% earlier in the session. So I guess this reflects the concerns among investors as that clock ticks down to that tariff deadline coming up in less than an hour from now. Rest of Asia, well in the green. We're seeing the chips, auto stocks in Japan doing well, the export-related counters. But this is Trump we're talking about. Things could quickly change, and I guess reflecting some of those concerns, we're seeing how on the Nikkei, it's not quite recouping the almost 3% losses of a day ago. Worth noting there, Paul.
Definitely worth noting. Volatility, the name of the game. Avril Hong there in Singapore. So President Trump has agreed, as we've been discussing, to delay 25% tariffs on Canada and Mexico for a month after both countries agreed to take tougher border control measures. Mexican President Claudia Sheinbaum agreed to send 10,000 National Guard officers to the border to stem the flow of migrants and fentanyl into the U.S.
In terms of trade, my proposal was the same one. Why don't Mexico's Secretary of Economy and the U.S. Secretary of Commerce work together so that we can also get results and learn about these issues? Then he agreed, and at the end asked me how much time I wanted to put on pause. I said, well, let's put it on pause forever. And he asked how long. I said, let's put it on pause for a month. And I am sure that in that month, we will be able to have results. Good results for his people and good results for Mexico.
News Desk editor Jill Desis joins us now with more. So, Jill, walk us through the details of this month-long delay.
Yeah, Paul, well, I think, you heard a little bit there from the Mexican President, Claudia Sheinbaum. Ultimately, this does come down to this 11th hour idea of a reprieve for both Canada and Mexico. As we saw there, they have agreed to follow through on some of the things that Trump has been asking for. Canada in particular said they'd appoint a fentanyl czar, so kind of, putting somebody in place to deal with some of the issues that Trump said he was taking issue with when it came to sort of border security, concerns about the fentanyl trade and that coming into the U.S. from these neighboring countries. Ultimately, though, it does kind of still speak to this idea that there's a lot of uncertainty over what sort of a lot of this policy looks like under Trump. I mean, he has been really aggressive with this idea of implementing tariffs. Now we're looking at this 30-day reprieve. Does he actually follow through with some of these threats if he doesn't get more concessions from Canada and Mexico? That's ultimately what we're going to have to see the next 30 days be about. But it's starting to kind of resemble actually a bit more of his first term when we saw some of these threats. There was some concern about how much of that was going to be empty, how much of that was going to be realized, and what kind of deliverables it actually resulted in. But again, I think kind of a pretty wild and very classically Trumpian turnaround that you're seeing just within the last 24 hours or so. We'll have to see what that ultimately looks like during this month-long reprieve here.
Yeah, well, we'll have to see in terms of China as well, because we might be seeing 10% tariffs within hours there, and 10% looks like it pays to not be an ally of the US.
Yes, that's right, Paul. Yes, I mean, within an hour, effectively, unless we actually hear that there's going to be a reprieve on China, he's still set to go ahead with those 10% tariffs there. Again, I think that's also kind of speaking to the type of Trump that we really saw during his first term in office, where he was focused more on, applying those types of tariffs against adversaries like China rather than economic allies in the form of Canada or Mexico. We still haven't heard whether or not any of this is also going to be, facing reprieve. If, you kind of go by, what the White House has ultimately been, trying to make public here, it's that if there's no news, then, we have to assume that point that at, midnight U.S. Eastern time, so that's just about an hour from now, that he may, end up going along and putting together those tariffs and putting more pressure on China.
Is this just part of the Trump playbook, though, to get President Xi to the table? Because he says he does expect to speak with Xi Jinping.
Yeah, that's actually one thing that we're kind of looking at here, Paul. We want to kind of see whether or not, there's some kind of a call with Xi Jinping or other, Chinese higher-ups, tonight to see if they can stave off this type of, these tariffs. I will say one thing that was interesting is Trump, just a couple of hours ago, actually posted on his Truth Social account, that's the social media platform that he has, to, say that you kind of use this idea of, a TikTok deal. That's something that's been kind of at the center of his negotiation strategy with China, is this idea of selling off this Chinese-owned the U.S. components of this Chinese-owned app, and trying to get a U.S. buyer, a U.S. partner involved there. So the fact that he's kind of musing that online in the late hours of Monday night in the U.S. makes me wonder how much of this is sort of prepping for any kind of a conversation with either Xi Jinping himself or anyone else within China's leadership to try to get some kind of a negotiation on the table. Again, I do have to point out we're still on the last day of a week-long Lunar New Year holiday in Beijing. So you've also got that to contend with, the fact that markets have been closed there. We haven't really seen a lot of the weight impact of what these tariffs could ultimately represent here. But I think that all just kind of goes to show you, Paul, that there's still a lot that's left on the table here for both the U.S. and China to kind of deal with, and we're still waiting for any kind of clarity on what this is ultimately going to look like, and how we're going to see that U.S.-China relationship evolve going forward.
All right, News Desk editor Jill Desis there. Well, Asian stocks have made gains after the tariff delay. US futures also in the green, but looking longer term, former JP Morgan strategist Michael Kolonovich remains bearish on the S&P 500.
I do think we'll go back down in the 5,000s this year sometimes. I think at that point in time, we will see whether the cycle is still strong or it's not. I think we need to see the whole new political climate, whether it will lead to turmoil. And I believe more likely than not it will. So those things I think will get us lower, right? At that time, whether it becomes an end of a cycle and we go much lower into 4,000, that I don't know. I think there's some probability of that.
Well, joining us now is Geoff Yu, Senior EMEA Market Strategist at BNY. And Geoff, I just want to pick up on that point around your outlook for the S&P and other major indexes as well. I mean, markets seem to be having a really hard time pricing outcomes at the moment. What's the greater force here, the tariff story, the political story, or just good old-fashioned earnings and fundamentals?
Morning. So I really think it is about fundamentals, ultimately. Let's see how all of this fluid situation feeds through into policy expectations, feeds into the underlying US economy. So just picking up on the view, is there more downside in US equity markets? I don't think that's the right narrative at this point. It's just this broader theme about US exceptionalism, which has been underpinning entire asset allocation over the last few years. Maybe a bit more questioning of that, but to call it in either direction for now, I think it's a bit too early.
Yeah, well, we saw a huge sell-off yesterday and then an equally impressive rebound today as markets got whipsawed on that tariff story. I mean, do you even try to trade around this volatility, or can you make some good money trading around this volatility? And when you consider this fire hose of headlines, what do you do?
Well, I don't know if it's the quote-unquote new normal yet or the old normal, but if you look at the ranges in dollar CAD, for example, several hundred pips over 24 hours, we've had that for quite a few sessions now. You know, these are ranges that we haven't really seen for quite a few years within FX markets, within macro markets. So I think from a trading point of view, from an asset allocation point of view, sharp ratios, they need a readjustment because you just have to price in higher volatility. That's going to be here for quite some time.
So are there any stock or sector-specific stories that you like in this kind of environment? Where do you put money to work?
Well, ultimately, we look at our underlying flow monitors, as the world's largest custodian. So looking at, where there's some under-positioning. And one of the themes this year, and it has been APAC, and it has been Europe, where relative to the US, again, relative to that US exceptionalism theme, our clients globally have been under-positioned. So we're looking for some form of convergence. Now, just to stress, that doesn't mean that we're suddenly going to see clients go overweight Europe or Asia, given the current risks, anything but that outperformance of the US, I think on a relative value basis, that's where we're going to see less of a widening. So regional realignment, I think, that's where asset allocation is going to come into play. And from a sector point of view, people are looking at value at this point, but also I think it's more of a regional play, and we are looking at Europe, notwithstanding the current risks.
And you're looking to hedge against some of this volatility or increase your allocations to havens at all? Because if we take a look at the gold price, it's been on an impressive winning streak. Is that an asset that you're looking at?
Well, is gold a haven in an environment like this? So you want liquidity, you want to be able to move in and out relatively quickly. I'd actually be looking at the likes of the Japanese yen. I know it's been undervalued, being called a haven, an underperforming haven for quite some time, but we are identifying flows heading into that. But sometimes people would look at Swiss franc. But having said that, if you look at what could happen to the Swiss franc, especially with respect to tariffs on pharma, for example, that could impact that. So I would look at the funders in APAC right now. A lot of valuation gains led by the yen, and also some others, looking at revisiting sterling, for example, if things can actually stabilize. Aussie looking very good in terms of valuations, unless we forget it is a reserve currency as well, albeit a secondary one. So quite a few options out there. You're looking at like a stock picker's paradise in the same way for macro markets as well.
Yeah, it's interesting you mentioned currencies because we have seen some pretty huge volumes there to kick the week off. I want to ask you about the euro as well, though. Do you think we'll see parity within the next few months?
Yes, and sooner rather than later. And I think the main risk right now is, markets are looking for what the situation is with bilateral trade between the US and the EU, and can the EU muster a swift reaction. But crucially, the ECB reaction function will be, if there is going to be trade volatility, then maybe they will lean towards adding to rate cuts right now, whereby the Fed is pretty comfortable with the state of the US economy. They said so themselves. The US economy is in a good place. So that initial divergence, that repricing, I think that will be reflected in euro-dollar going through parity. But our clients are very underheld, very overhedged in euro right now. So I wouldn't want to chase through parity. And again, going back to the European asset allocation view, looking for some value once those levels are met.
All right, Geoff Yu, Senior EMEA Market Strategist at BNY. Thanks so much for joining us. Still to come, the Israeli Prime Minister is set to be the first foreign leader to visit the White House since President Trump took office. More on what to expect up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. President Trump will meet with Israel Prime Minister Benjamin Netanyahu at the White House this afternoon. Netanyahu is the first foreign leader to visit the US since Trump's return to the Oval Office. The two leaders are planning to discuss the Gaza ceasefire, but the president told reporters on Monday he has no guarantees that the peace is going to hold. So for more on this, let's bring in Paul Wallace, who leads Middle East, North Africa economy and government coverage as well. So, Paul, what's on the agenda? What's going to be discussed?
Hi, Paul. Well, they'll have a lot on the agenda, but I think first and foremost will be Gaza and the ceasefire. We're in the middle of the first phase of this truce. It's meant, that phase is meant to end in early March, and then we go to phase 2, which is supposed to effectively make the ceasefire permanent and end the war between Israel and Hamas. There are still big question marks as to whether we'll get to the end of phase 1 or whether we can even, if we do, whether we transition into phase 2. Benjamin Netanyahu is facing a lot of pressure among far-right politicians in Israel, including at least one government minister, to return to war to fully defeat Hamas. There's a feeling within some parts of Israel that Hamas is not defeated, and the only way forward for Israel is to return to hostilities and go back to war. Donald Trump's position on this is a little bit unclear, but I think the main signals from his administration are that it wants this ceasefire to continue beyond phase 1 and for the war to be over.
Yeah, the pressure on the Netanyahu government from the far right does underscore the risks around this ceasefire. What's the likelihood that these ceasefire talks are going to guarantee the implementation of phase 2?
That's a big question. I mean, even if Netanyahu does want to press on to stage 2, there's no guarantee that the sort of indirect talks between Israel and Hamas will achieve an outcome that allows the party to go into phase 2. There are a lot of things, a lot of obstacles that still need to be overcome. Questions such as who is going to govern Gaza, even in the short term. Israel wants Hamas to have absolutely nothing to do with the governance of the territory after Hamas's awful attacks on Israel in October 2023. But the problem is there's no obvious alternative to Hamas at the moment. It's clearly the strongest group still within Gaza, despite having been under Israeli bombardment and ground attacks for 15, 16 months now. The Palestinian Authority says it wants to take over the running of Gaza, but Israel is not so sure about that, and it's unclear whether the Palestinian Authority has the ability to do that. And then you get, if it's not then you get into tricky questions about a multinational force. And again, there's no, at the moment, there's no obvious country or group of countries that can step in and put forward things like peacekeepers and administrators. So it's extremely complicated.
All right, Paul Wallace, who leads Middle East, North Africa economy and government coverage. Thanks so much for joining us. Still to come, the EU bracing for its own set of Trump tariffs. We're going to take a look at the impact these potential levies could have on Europe's economy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. US President Trump says the European Union will soon face its own tariffs, calling the bloc an atrocity on trade. EU leaders, including Germany's Olaf Scholz, have vowed retaliation. Bloomberg's Oliver Crook takes a look at the impact potential levies could have on Europe's economy, and particularly Germany, with an election just weeks away.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word.
As the United States and the EU square up to what could be the next front in Trump's trade war, at risk is the biggest and most integrated bilateral trade and investment relationship in the world. There's no free trade agreement between them, but operating under WTO rules, they enjoy some of the lowest tariff rates anywhere, at about 3%. The EU and the US trade about 850 billion euros worth of goods, with Europe running a surplus of about 155 billion. Meanwhile, trade in services was worth almost 700 billion, where the US runs a surplus of about 100. Combined, the exchange of goods and services was bigger than almost every single European economy on its own, at least for now.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs.
According to Goldman Sachs, a 10% minimum tariff would reduce EU exports by about 150 billion euros every year, shaving off about 1% of European GDP. And Germany would pay the highest price. Germany's effort to de-risk from China has meant the trade relationship with the United States is more important than ever, and new tariffs by Donald Trump could cost Germany 15% of its biggest export market.
Bloomberg's Oliver Crook there reporting on the possible impact of US tariffs on the EU ahead of this month's German election. Now for a look at some of the other stories that we're following. Turkey's annual inflation eased less than expected in January and what could present a challenge to the central bank as it embarks on interest rate cuts. Consumer prices rose 42.1% year on year. That's down from 44.4% in December. The monthly inflation rate also surprised, coming in at 5%. That's the highest figure in a year, while health-related prices accelerated the most. Shares of asset managers slid after Vanguard cut fees for dozens of its mutual funds and ETFs. The cuts bring Vanguard's average asset-weighted fee to just 0.07%, compared with 0.4% for the rest of the industry. With the reductions the largest Vanguard has ever undertaken and could save investors $350 million this year. President Trump has signed an executive action to create a sovereign wealth fund for the US. The president says Treasury Secretary Scott Bessent and Howard Lutnick, as nominee for Commerce Secretary, will spearhead the effort. The action calls for officials to submit a plan within 90 days, including recommendations for funding, investment strategies and governance. Still to come, US Secretary of State Marco Rubio takes control of the USAID department and warns it could be abolished. We'll discuss the latest next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. A US tariff reprieve for Canada and Mexico pushes Asian markets higher. The two nations promising tougher measures on migration and drug trafficking in exchange for a 30-day delay on President Trump's 25% levies. And attention now turns to China. A threatened 10% tariff due to come into force today. The White House says Trump may speak directly with President Xi. And Israeli Prime Minister Benjamin Netanyahu set to meet with President Trump in Washington, and he's the first world leader to visit the White House since Trump's inauguration. It's just gone 3:30 p.m. here in Sydney. It's 8:30 a.m. across the Emirates. I'm Paul Allen, covering for Jemima Besetche. Let's take a look at how markets are tracking. Interesting moves in the bond space. We're seeing yields hovering around, or the spread between the two tens sort of hovering around that 30 basis point level. Still some concern in the bond market on not just inflation and growth, but also this tariff story. Even though the threat has receded for now, that is just a 30-day reprieve, of course, for Canada and Mexico. Seeing most of the assets on your screen there reacting to that tariff story. We've got weaker crude price, Brent crude off about 2/3% at the moment. That dropped after that delay to the tariffs that was announced. We've also seen relative strength for the US dollar. Some Asian currencies have made up a bit of ground since those tariffs were dropped, but we're watching the euro in particular. Our last guest, Geoff Yu of BMY, felt that we're going to see parity on that pair sooner rather than later. Right, let's get a look at Chinese assets now. Avril Hong's in our Singapore studio. Avril, what are you watching?
Yeah, Paul, I think it's that idea that tariff reprieve could be underway despite the clock ticking down to a deadline about half an hour from now when you look at Chinese tariffs from the US following that reprieve for Canada, for Mexico. So Hong Kong stocks are leading the way today and the rest of the region is looking pretty positive as well. That being said, if you look at the Hang Seng Tech or this gauge of Chinese stocks in Hong Kong, they've paired the gains from the morning session of about 4-5%. Dollar China continues moving lower, peeling away from the 737 handle of a day ago. I suppose traders are looking out for positive headlines, maybe a conciliatory tone from Presidents Trump or Xi. There's also this idea that coming out of the long Lunar New Year holiday tomorrow, when onshore markets return to trade, maybe we see Chinese authorities start announcing some of these big bazooka stimulus-like measures. Now, flip the board because I thought I'd just highlight what we're seeing on the Hang Seng Tech as well. This chart, courtesy of MLive's Mark Cranfield, shows you the patterns behind the jump in the Hang Seng Tech today, and perhaps reflecting the view that traders really want to believe tariff delays are coming. Maybe if these concerns are moved out of the way as well, then traders can focus on the deep-seek related benefits for Chinese tech names, especially for the likes of Alibaba. Don't forget, it reports earnings later this week. Paul?
All right, Avril Hong there in Singapore. Thank you. The US Secretary of State Marco Rubio has told Congress the US Agency for International Development may be abolished after a review. According to a letter seen by Bloomberg, Rubio says some operations may be integrated into the State Department, with others shut down.
USAID, I've delegated that authority to someone, but I stay in touch with him. And again, our goal was to go in and align our foreign aid to the national interest. But if you go to mission after mission and embassy after embassy around the world, you will often find that in many cases, USAID is involved in programs that run counter to what we're trying to do in our national strategy with that country or with that region.
Well, Min Lo is our China correspondent and joins us now. So, Min, what does this mean for the future of USAID?
Well, no one really knows what could happen at the end of this 90-day review period. And suddenly Trump has made his disdain of the agency known, saying that it's run by a bunch of lunatics. His words, not mine. And so hard to say because some Democrats have been vowing to fight back, saying that this is an assault on the independence of the agency, an assault on the authority of Congress, which has, of course, passed legislation to codify USAID and to fund it as well. And, of course, it's going to be a big blow to confidence in American leadership for many of these recipient countries that suddenly find themselves out of funding, potentially tens of thousands of jobs at risk as well, given that USAID tends to implement its programs with local contractors. And so they indirectly support many, many jobs across the globe. And these countries finding themselves now having to deal with public health crises that are no longer supported by the US. So it also then possibly creates a vacuum that maybe other countries like China can move into as well.
Yeah, so to what degree does this hand the advantage to some US competitors like China to plug that gap?
Well, we know that China has for a long time been trying to position itself as the champion of the global south. It's used the China-Africa Cooperation Summit to kind of champion that. It's been pouring a lot of resources. A lot of its foreign aid comes in the form of government-backed loans for infrastructure investment. And from 2000 through 2021, they have invested some $1.3 trillion in such loans, and that really dwarfs the amount that U.S. has spent in a competing sort of framework that has a portfolio of only about $50 billion of projects consisting of railway and the like. And so, yes, it opens up room here, but some analysts say that China is unlikely to immediately fill in that multi-billion-dollar gap, given that its economy is not exactly in very healthy shapes. That also raises the question of how much China can continue to spend big. But if you look at last year's pledge, China had pledged about $50 billion in such investments over 3 years. So still pretty substantial, despite some questions around how sustainable it is. And so, you know, this freezing of that U.S. aid funding could potentially come at the expense of American primacy.
All right, Min Min Lo, Bloomberg's China correspondent. Thanks for joining us. Well, Tata Motors is keeping a close eye on President Trump's trade policies and their possible impact on its crucial China market. CFO PB Balaji told us exclusively that they're ready to reassess their business strategy if necessary.
I think this is the new normal that we are trying to comprehend as we speak, because things are coming thick and fast. So we need obviously time to process the changes, and more importantly, how the response happens, not just vis-a-vis country to country, it's also in terms of what happens to financial markets, what happens to currencies. So I think from our perspective, we are trying to keep it clear and focused, otherwise we'll end up panicking everywhere. Let's take one at a time. If I look at the UK market, which is one of our, because we are an exporter out of UK, the balance of payment UK versus US is the other way around. US exports more into the UK compared to the UK to the US. So frankly, I believe this is the task. I mean, this is the data pattern at this point in time. How does that get comprehended? How do people deal with it? We'll have to wait and see. And as far as our exports into China, the domestic market in China itself is concerned, I think the premium luxury business has been reasonably healthy. At the same time, yes, there have been stresses in the last 1 year in the Chinese market, and therefore we are watching it closely. And our plan of action is to ensure that we stay relevant to our customers in that particular market. And so far this year, JLR has performed better than any other player in the market with respect to the the sales that we are doing in that particular market. And we need to ensure that both the product offering as well as the dealer remuneration that we are able to secure in that market is remunerative for the dealers. So let's watch the place. From our perspective, we'll also want to do is keep the innovation intensity high so that the customers still feel attracted to our products. Price is just one variable in the grand scheme of things. We need to ensure that we increase the degrees of through which customers assess us. That's how we are approaching it.
But have you reassessed your strategy in light of the tariffs? I mean, have you made changes, for instance, to your strategy?
Not yet. Not yet.
But you may?
We will keep a watch on it. We need to understand how it is going to play out. And obviously, you wouldn't want to overcorrect on this front because it's also a moving target at this point in time. Let's wait for the data to emerge, and then we'll obviously course correct if needed.
We know that demand in China has been pretty lackluster, and the U.S. market has been able to counter that.
Right.
Do you see that continuing? What kind of trends are developing?
See, at this point in time, that is the situation, and I believe the U.S. will continue to do well for us. And the products are good, and the launches that we are seeing, because earlier, if you go back to the portfolio that we had, the biggest successes for us was Range Rover and Range Rover Sport. The launch of a Defender has actually given us a third leg in that tripod. And as and when we fix and correct and launch Discovery, then that'll be the fourth leg of a proper stool that we will be having. So in that, I think the Defender portfolio is now adding to the additional volume that you're getting out of US, which is also compensating for the relative weakness that you're seeing in China. But we believe that will also change as we go forward because China is going through its own corrections, and therefore when it comes back again, we hope to have two markets that are firing in parallel, China and US, but let's wait and see how early it comes. But that's not all. We are also seeing the UK business coming back because UK business had a challenge on insurance and thefts that was causing us grief last year. Now that is behind us because the technology has been fixed, and now we're getting insurance back into the fold again. We also set up our own captive insurance reinsurance to take care of that, so that price discovery is out there. So that's giving UK back into that action. And the kind of launches we are seeing on the Range Rover and Range Rover Sport, the products have done so well. Middle East is becoming an important market for us as well. So I think as the business is getting more and more catering to the premium luxury customers, these people are a sliver that goes across the entire world, and they are responding to the products.
So now different sources of growth.
Different sources of growth are starting to come through. That is balancing the portfolio, which is the reason if you look at the last quarter, we delivered our highest ever Q3 EBIT margin of 9%, which has never happened for the last 10 years as far as JLR is concerned. So we are on the right track on JLR. The key shift that has happened compared to the JLR of the past is the pivot towards premium luxury. It is a brand-led growth. It's a luxury customer that we are dealing with, and the vehicles are actually delivering to the promise that we are putting to the customer. So that's giving us the confidence that whatever may be the storm out there, we should be able to weather it well.
That's Tata Motors CFO PB Balaji speaking exclusively with Bloomberg Insight anchor Haslinda Amin in Mumbai. Still to come, M23 rebels in the DRC declare a unilateral ceasefire as African leaders agree to hold crisis talks. Details next. This is Bloomberg. Welcome back to Horizons in Middle East and Africa. I'm Paul Allen. M23 rebels in the Democratic Republic of Congo have declared a unilateral ceasefire for humanitarian reasons. That's as the group of 7 nations demanded the Rwanda-backed militia halt an offensive that's shaken the eastern part of the country. The UN says at least 900 people were killed in Goma during the assault. Well, let's get more on this with Bloomberg's Ondero Oganga. So, Ondero, what can we expect following the ceasefire announcement, and is it expected to hold this time around?
Hi, Paul. So what we can expect is a pause in the fighting and the offense from M23. They have said that they have no intention of expanding territory into Bukavu, but what they intend to do is protect their position and also civilians. And going back to what the UN is saying, these 900 people that have been confirmed dead were bodies that were lying on the streets. This is not counting the bodies that were in the mosques. 2,800 people have been injured. The hospitals are overrun. Goma is a city of 2 million people, yet it's in dire need of water, of fuel, of medical supplies, and also of food. And, you know, Rwanda has always denied allegations that it's backing M23 rebels. And this is the basis of which they're going into the new joint heads of state summit between EAC and SADC. And they're hoping to find a consensus during that meeting. President Felix Tshisekedi of DRC has confirmed to attend, unlike last time where he did not show. But then again, there's very little room of seeing eye to eye between the two countries. President Paul Kagame of Rwanda, despite denying that Rwanda is not backing M23 rebels, said he didn't know if Rwandan troops are in the eastern part of DRC when asked by CNN, and instead shifted blame, saying those people that are stealing DRC's minerals are South Africa and European countries. So this should form for a very interesting basis for the meeting coming up over the weekend.
So what case is DRC trying to make to international bodies to cease its partnership with Rwanda over the alleged support of M23 rebels?
So DRC has written to Arsenal, PSG and Bayern Munich asking them to end their sponsorship with Rwanda on basis of escalating tension in the region, threat of a full-scale war, and countless lives that have been lost, alleging that Rwanda is behind this misery. RDB of Rwanda signed a partnership with Arsenal in 2018 to be their sleeve sponsor, and similar deals followed with PSG and also Bayern Munich. And Congo is alleging that money that has been gotten from trafficked minerals is what is being used to fund these sponsorship deals.
All right, Bloomberg's Ondero Oganga in Kigali there. Thank you. Well, South Africa's Mineral Resources Minister says coal is making a comeback and should be considered a critical mineral for the nation because of its contribution to employment and the economy. He told a mining conference in Cape Town that, quote, King Coal is back, adding that the death of the dirtiest fossil fuel has been declared prematurely. He also weighed in on President Trump's threat to stop funding for South Africa, saying if they don't give us money, let's not give them minerals. Ghana's annual inflation rate fell for the first time in 5 months as a new governor prepares to take the helm of the central bank amid mounting risks to prices. Consumer prices rose 23.5% in the year to January. That was slightly less than economists were expecting. Non-food price growth that led to the slowdown in overall inflation. Food inflation, though, remains sticky, accelerating to an annual rate of 28.3%. Nigeria has set itself a target of boosting daily oil production by about 60% to 2.7 million barrels per day by 2027. Africa's biggest producer is planning for the surge to come partly from oil condensate, a lighter, more volatile hydrocarbon, rather than just crude. And that would allow Nigeria to largely keep within its OPEC plus quota of 1.5 million barrels of crude per day. Coming up, more on oil. OPEC and its allies will maintain production curbs this quarter. That's despite the US president's calls for lower prices. We'll have more on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Oil fell after President Trump delayed the start of tariffs against the country's two biggest foreign suppliers of crude by a month. OPEC and its allies said they'll maintain production curbs this quarter, even as the US president called on the group to lower crude prices by expanding output. Let's bring in Anthony DePaula, Bloomberg's energy reporter in Dubai. So, Anthony, what can we understand from the OPEC Plus meeting yesterday and their behaviour so far about how they're going to react to President Trump's call for lower oil prices?
Yeah, good morning, Paul. Exactly as you said, the context going into that was that Trump, in his address in Davos, and since then has called on OPEC to lower the cost of oil. He wants lower pump prices in the United States. And that would indicate that he wants them to increase production. He's, of course, talked about increasing U.S. production. But we don't see OPEC jumping to that immediately. In fact, we did see the most specific comments coming out of the meeting yesterday, coming out of the group, actually, were from the Russian head of energy, Novak, who is saying that the U.S. efforts are an effort to win market share, and that the group should resist that. Of course, Russia is under sanction that's targeting some of its oil exports, some of the vessels transporting its oil. So Russia's in a particular position where they are targeted. But we don't see the wider group really making that much of a comment about it, nothing specific. We did see some ministers go to Riyadh shortly after those calls from Trump, kind of a sign of unity by the group that they are going to stand together. Some of the members there, Iraq and the UAE, that did travel to Riyadh are some of those countries that have not really met their quotas in the past. So that's been an issue for OPEC in terms of trying to control the market. But we do see them sticking to that plan, which remember is to increase production by a small amount in April. So while OPEC is not immediately reacting to the Trump call, they do have this increase coming up in April. So probably they are talking behind the scenes, talking to the administration, trying to portray that as an increase, as efforts to balance the market and make sure that price doesn't go too high, Paul.
So in terms of some of the swings that we've seen around the tariff risk, do you think we've seen the end of it yet for the oil price, or is there potentially more to come?
Yeah, I think there's definitely more to come. I think we're in for a lot of volatility this year in general, because you do see a lot of different moving factors in the market already this year, and that is around some of the potential sanctions measures, again, against Russia. We've got potential moves against Iran, and now we've got this aspect of the tariffs coming in. What we've seen in the oil market throughout the past several years is that the oil market is very flexible. It will get the barrels to where they need to be. It will make changes and adjustments. And so what we're going to have to see here, if and when those sanctions, the tariffs on Canada and Mexico do come in, what we'll have to see is a flexibility and a change, because both Canada and Mexico export a lot of oil to the United States, which the U.S. needs to kind of balance its lighter crude with some of that heavier crude that comes from Canada and Mexico to optimize the refinery operations. If that oil is slower coming in, has some issues or higher costs, that could impact the pump prices directly in the United States. Of course, we have seen that oil exports would come at a lower tariff level, but we'll have to see, do they come in? Is this an opening bid for other tariffs or other negotiations with Mexico and Canada? And other countries that Trump has threatened with tariffs will probably be taking this as a lesson. Let's get our negotiating positions in order so we can stave off those tariffs as well. So the market's going to have to be really on its toes to react to these things as they come or as they don't, as they get delayed and as other negotiations take place, Paul.
All right, Bloomberg's Anthony DePaula, thank you. And in terms of tariffs, we're seeing some pretty profound impacts of U.S. tariff threats on pretty much any asset you can think of, including the Chinese yuan, of course. No trading in China at the moment. It is still the Lunar New Year holiday, but we've got the offshore yuan hovering around record lows. The number to watch there, 7.3749. We could have 10% tariffs being introduced for China within the next few hours. President Trump, though, saying he wants to speak to Xi Jinping. Right, that's it for the first hour of Horizons. Alan Higgins from AUB Bank joins us on Market Action next, as well as Jennifer Zabasaja live from Cape Town. This is Horizons Middle East and Africa. Our top stories this morning. A US tariff reprieve for Canada and Mexico pushes Asian markets higher. The two nations promising tougher measures on migration and drug trafficking in exchange for a 30-day delay on President Trump's 25% levies. Attention now turning to China, a threatened 10% tariff due to come into force today. The White House says Trump may speak directly with President Xi. And Israeli Prime Minister Benjamin Netanyahu is set to meet with President Trump in Washington, and he's the first world leader to visit the White House since Trump's inauguration. Good morning. It's just gone 4 p.m. here in Sydney. It's 9 a.m. across the Emirates. I'm Paul Allen.
And I'm Jennifer Zabasaja in Cape Town, where it's just gone at past 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. And I'm joining you live from day 2 at the Africa Mining Indaba Conference here in Cape Town. Paul, Monday was a busy day, as last week was when we were talking about DeepSeek. Yesterday was all about tariffs and the potential knock-on effects for a lot of these mining companies and governments here. So we'll see what today brings, because a lot has changed just in 24 hours.
Yeah, that's right. It has been a wild ride. We've seen some huge volumes, and President Trump's favourite word in the dictionary, tariff, pretty much impacting every asset that it touched. Let's take a look at some of what moved. Among them, yields. We've seen the 210 spread hovering around about 30 basis points. It's not just concerns over inflation and growth here. It is that tariff story as well. And that's the Bloomberg question of the day, in fact, is will we see that yield curve inverting again? But take a look at crude prices. We were discussing that just a few minutes ago as well. They retreated as well on the news that President Trump was going to delay those tariffs on Mexico and Canada by 1 month, on promises that there's going to be stronger controls around the border. S&P futures, well, they're giving up some of the gains that we saw earlier, but they're still in positive territory. And the euro, one to watch among other currencies. We have seen some Asian currencies improving their position against the greenback, but the euro, one of those we're watching ahead of the budget in France, also the German election as well. And you see just across the bottom of the screen there also, the deadline has just passed for President Trump's 10% China tariffs, so those are going to take effect now. We've got just taking a look at the movement in the offshore yuan. That's 732.03 at the moment. Still a little bit short, or some distance short of that record low, but that's the next threshold that we're watching, 7.3749. With that in mind, let's check in on how markets in Asia are faring. Avril Hong's in our Singapore studio. Avril, what's moving?
Well, as you say, the offshore currency that actually clocked about 0.1% gains in the morning session, reversing that quite quickly as that tariff deadline has come and gone. No signs of that delay, or perhaps a conciliatory tone between the Presidents Trump and Xi. Any positive headlines on that direction as well. And another read of how quickly the positioning or the sentiment is reversing. Look at how the Hang Seng has come back from the lunch break, about 2% higher going into lunch, and reversing some of those gains now, as have the Hang Seng Tech and this Chinese gauge of Hong Kong, or Chinese shares listed in Hong Kong, I should say. But I guess if you want to focus on some of the positives, many of the economists we've been speaking to say that 10% tariffs, China would be able to withstand, to weather the hit. And then for Chinese tech stocks in particular, they kind of still have that DeepSeek narrative going for them. And I think some of our colleagues have also been talking about this on the MLive blog. That has helped to reignite Hong Kong stock interest as well. So putting things in perspective, even as we see this deadline passing, Paul.
All right, Avril Hong there in Singapore. Thanks for joining us. And President Trump, as we were discussing earlier, has agreed to delay 25% tariffs on Canada and Mexico for a month, even as these 10% tariffs on China come into effect. Both countries, though, agreed to take tougher border control measures. Mexican President Claudia Sheinbaum agreeing to send 10,000 National Guard officers to the border to stem the flow of migrants and also fentanyl into the U.S.
In terms of trade, my proposal was the same one. Why don't Mexico's Secretary of Economy and the U.S. Secretary of Commerce work together so that we can also get results and learn about these issues? Then he agreed, and at the end asked me how much time I wanted to put on pause. I said, well, let's put it on pause forever. And he asked how long. I said, let's put it on pause for a month. And I am sure that in that month, we will be able to have results. Good results for his people and good results for Mexico.
Bloomberg Asia senior editor Bill Ferries joins us now with more on this story. So, Bill, it's a 1 month reprieve. We're speculating here, but is enough going to happen in that month to have these tariffs, well, indefinitely set aside, as Claudia Sheinbaum really wanted?
Well, yeah, March 4th is the new deadline, and we may not be able to answer your question till late on March 3rd. But certainly, the President Trump going to claim some success here with both Canada and Mexico agreeing to step up their border protection efforts, even though in Canada's case, this is part of a $900 million plan that they had announced in December. But they're appointing a fentanyl czar. They're going to do more coordination with U.S. border forces, and they're going to look at fighting organized crime together and money laundering. So I think President Trump will hail this agreement. He said that there's no deal yet on tariffs with either country, but that fear of 25% tariffs is at least kicked down the road. It shows that he's willing to negotiate on this, but he's going to leave that threat hanging out there for at least another month.
Well, Bill, there's one set of tariffs. We see the threat receding. We've just got another set being put in place on China, that deadline lapsing. So it's 10% broad-based tariff on China. And China has already responded. I'll just read you some of what we've heard so far. There's going to be a probe of Google over alleged antitrust law breaches. That's according to the State Administration for Market Regulation. But also, China's going to impose a 10% tariff on oil, agriculture, machines from the US. Are we heading to a dark place here, or is this just another negotiating tactic? And tomorrow, could we hear that all of this gets wound back on some sort of agreement?
I think yes to all of that. It's all certainly possible. We had been waiting for news that President Xi Jinping and President Trump were going to have a phone conversation. We didn't know. We don't know when that is happening. It doesn't seem like it's happened this evening in the U.S. hours. So those tariffs have gone into effect, 10%. Of course, that's not the up to 60% that President Trump had campaigned on over the past year, so not the most severe or worst case scenario, but these tariffs could be in place for a long time. I think President Trump will be looking for certain concessions, and China clearly showing with its retaliatory tariffs and this probe into Google that it's not going to sit back and just take those tariffs unanswered.
All right, Bloomberg Asia senior editor Bill Ferries there. Let's just recap some of those headlines that we've had. The deadline for US tariffs on China lapsing, so that's happening. 10% blanket tariffs on China from the US, and China wasting no time in retaliating. So among the headlines we are receiving, there will be a probe of Google over alleged antitrust law breaches by China. That's according to the State Administration for Market Regulation. China will also impose a 15% tariff on coals, LNG imported from the US as well. So a 10% tariff on oil and agriculture machines from the US also. Now, we're seeing some market reaction as well. You have there on your screen the offshore yuan, seeing a bit of weakness there. 733.28 at the moment. The weakest on record is 737.49, so keep that number in mind. But we're also seeing some movements in NASDAQ futures as well. NASDAQ 100 futures are sliding on that news that China is going to probe Google over alleged antitrust law breaches. So the tit for tat well underway. Asian stocks, meanwhile, made gains after that tariff delay on Mexico and Canada. US futures also in the green, NASDAQ 100 notwithstanding. But looking longer term, former JP Morgan strategist Marko Kolonovich is remaining bearish on the S&P 500.
I do think we'll go back down in the 5,000s this year sometimes. I think at that point in time, we will see whether the cycle is still strong or it's not. You know, I think we need to see the whole new political climate, whether it will lead to turmoil. And I believe more likely than not it will. You know, like, so those things I think will get us lower, right? You know, at that time, whether it becomes an end of a cycle and we go much lower into 4,000, that I don't know. I think there's some probability of that.
Well, joining us now, Alan Higgins, Chief Investment Officer at AUB Bank. Alan, I hope you're enjoying the news flow at the moment because we've just had the news of the 10% tariffs impacted on China retaliating. When you see action like this, what's your instinct? Do you try and trade around this volatility or do you just trade through it?
Morning, Paul from Dubai. Less trading. Look, we're a private bank, so we tend to be longer term and ideally take advantage of these situations. But look, some of the analysis I've seen kind of longer term is, you know, worst case, this is before the tariffs got delayed in terms of Mexico, Canada, was earnings per share hit for US equities of 3%. I saw that from Goldman's. I mean, that's obviously a negative, but it is a bit of a one-off. But yeah, we would look to take advantage of any correction. I just heard what you said about Marko. He's obviously been cautious for a long time when it comes to risk assets. But yeah, our approach would be to advise clients to take advantage of any correction.
Yeah, well, we're seeing indications that we might have a correction on our hands at the moment. US futures, after being in the green for most of today, are now backpedaling. We're seeing some reductions in terms of like a third of 1% for the S&P, for the NASDAQ 100 as well. So do you consider that a buying opportunity based on what you just said, or do you prefer to sit back and wait, considering some of the price action we've seen in the past 24 hours?
Well, listen, Paul, putting tariffs to one side, we're long overdue a correction anyway. And so the question is, you know, what works to help you find out if there is going to be a correction? And the best indicators out there tend to be sentiment related. And, you know, for example, I mean, you can pull this up on the terminal. The Conference Board does an interesting sub-indicator of basically how consumers are feeling about stocks, how positive they are. And that is absolutely off the charts, higher than it's ever been before. So indicators like that tend to be contrarian. But for us, in terms of advising clients, Paul, corrections are normal. Last year was unusual, as you know. In the US, we didn't get a 10% correction. Normally, every year you have a 10% correction. And yeah, so I was wondering, tariffs and the combination of this very bullish sentiment could be enough. But it looks like the market is coming to terms with tariffs and looking through and looking for a negotiation on all three sides, Mexico, Canada and China.
To what degree does this sort of thing impact your outlook for rates as well? Because how does the Fed, other central banks see their policy evolve when there's, well, such an unpredictable news flow?
That's fair. I think it's clearer in Europe, isn't it, Paul? I mean, ECB on an easing cycle, very weak economy, notwithstanding a slight uptick in inflation yesterday, pretty subdued inflation. When it comes to the US, our work focuses on what's important to the Fed, and for us, it's basically they see policy as tight. And so what are they looking at? I mean, there's a number of ways of looking at it, but basically real Fed funds or real short rates. And, you know, for example, if you look at forget current inflation. If you look at, say, the 5-year break-even as a longer-term measure, it's hovering just below 3%, whereas the long-term average is 1.5%. So you look at it from the Fed's point of view, they're seeing policy as tight. So our bias would be lower rates anyway, provided that inflation is reasonably controlled, because the Fed sees policy as tight. So I was intrigued with your question of the day, is the curve going to invert in the States? For us, no. We see lower rates at the front end still. And just as we've seen in the latter half of last year, when the Fed eases, the longer end sells off. And so taking duration risk is not really attractive for us. We prefer credit-related strategies, short-duration credit-related strategies.
All right, so you're staying away from duration, but if you want to hedge around some of this volatility, maybe diversify, where do you go for safety right now?
Paul, yeah, as a multi-asset investor, that's kind of the hardest question. Where can you, if you like, hedge? Because obviously equities is the main building block for nearly all investors like us, being a private bank, and where can you hedge? And one area we've found attractive for some time is gold. So apart from allocations from the likes of us, there is structural demand from gold for, if you like, unintended consequences of freezing Russian assets. Very understandable. But if you're a central bank in China or other places, allocations to gold becomes attractive. And of course, as I'm sure you know, Paul, a lot of this gold buying is unreported. So you've got basically multiple central bank buying supporting gold, plus people like us looking to, as you said, diversify.
Alan, okay, Alan, we're out of time, unfortunately, but thanks for joining us. Alan Higgins, Chief Investment Officer at AUB Bank. Thank you so much for joining us. Gold around record highs at the moment. Still to come. Jen's got some great guests from the mining indaba in Cape Town. Rohitesh Dhawan from the International Council on Mining and Metals on what impact President Trump's tariffs might have on Africa's mining industries. Up next, though, KoBold Metals aims to lead the race for critical minerals needed for the energy transition. And we'll speak to the Africa CEO next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town at the Mining Indaba conference. Now, KoBold Metals is a U.S. company backed by the likes of Bill Gates and also Jeff Bezos that uses artificial intelligence to explore for materials key to the green energy transition. Back in January, just a few weeks ago, it announced it had raised over $500 million in its latest funding round, valuing the company at almost $3 billion. So joining us now on set here live is the company's Africa CEO, Mfikeyi Makayi. Great to have you on, Mfikeyi. I know it's been a busy 24 hours already at this point. Let's start with Zambia, because that's been very key for KoBold's expansion. Zambia's second biggest copper producer on the continent, and KoBold is choosing to make it the home of your first mine. Considering all of the projects you're exploring, why Zambia?
Thank you for inviting me. It's exciting to be back in Cape Town at the Mining Indaba. And it's an exciting time to be in the space of critical minerals. So Zambia's fantastic. I also happen to be Zambian, happen to come from the mining industry, and it shows the value of places that haven't been fully explored, contrary to popular belief. So KoBold has been able to unlock value in the Mingomba deposit, which is the largest high-grade undeveloped copper project today, which will produce more than 300,000 tons of copper by the mid-2030s. We're really excited to be developing it, and we want to do that for our next discovery and the discoveries after that around the world.
Well, we mentioned the recent equity investment that you got. How much is it going to cost to actually expand this project there? How much are you really trying to invest in this specific one?
Well, we've moved towards our full mine design and build. We're still exploring on the asset and still drilling, but the build we estimate will cost us about $2 billion.
$2 billion.
That's right. So
you're putting a lot of investment then into this mine. Do you really think it's going to deliver the projections that you've actually estimated? What are your thoughts there?
Well, in the world of copper and any other critical minerals about grade, we're talking about more than 5% copper. Around the world, average copper grades are about 0.6% copper. We have an asset that's more than 10 times that. So that value is already delivered because we've done the work and it's been enabled by our technology, being able to predict where we're drilling, being able to predict how we will mine the asset.
So talk about some of the partners then that are going to be on board with this. We mentioned some of the investment. I mean, you have the likes of Bill Gates, you have Andreessen Horowitz. I mean, a lot of big names that are coming in. Who are the partners that are going to be focused on this specific mine?
Well, this is why we at Indaba. We're talking to different people, and in other parts of the world, we're talking to different people. Mingomba is co-owned between KoBold and the Zambian government through ZCCM-IH, and we're in the early stages of looking at how we're going to engineer and design the mine. So the point of being here is to be able to network. Those will be able to build this asset out with us.
So you don't have a partner at this point in time?
No, we don't.
What are some of the discussions, though, at this point? It's been 24 hours here in Mining Indaba. What are some of the people who are approaching you, and what are you looking for in a partner?
Well, it's all levels of discussion. So down to capacity to build, who has build experience. We're looking at different types of financing for the assets for the long term, right through when we get into production and commissioning.
So, I mean, talk about some of those partners then. Are they coming from the West? Are they Chinese? Are they, I mean, give us a little bit of insight if you could.
Open-minded. So some African partners. We're on the African continent. What's important is being able to spur African growth, doing business in Africa. So South Africa is obviously a home for lots of mine developers, most partners from the West. We look around the world, we're agnostic to where people come from.
So then, I mean, when it comes to financing, because you mentioned that is very important, we hear a lot about that and the importance of that when it comes to, I guess, the sustainability of some of these mines. What is the financing then looking like for you, and what are the partners that you're then looking for?
So, as I mentioned, we're looking at $2 billion. Right now, the company has raised another round, which will go into most of the exploration for all our copper assets, or rather, our critical mineral assets around the world. We have 60 projects on 4 continents.
Right.
So we need to look at the company as a whole and where we're prospecting and exploring. We know what Mingomba will need, and we have a couple of years to figure out how we're going to do the capital outlay on the asset.
How many years are you giving yourself to actually see this through?
We'd want to get into early production by the 2030s, and we're working closely with the Zambian government to enable that. We've already moved into our shaft sinking and engineering plans and designs for mid-2026.
And I wonder, how much is copper essential to the business? We were talking about tariffs and the trade tariffs really sort of having an effect on commodity prices. But is this going to be the bottom line for the business, or are you going in on other potential minerals that could help offset some of the volatility that we're seeing?
So we are focused on all the critical minerals, particularly that will be enabling future technologies. So copper, lithium, nickel, cobalt, those are quite essential. Mingomba happens to be a copper asset, but we're not limiting ourselves to only looking for a Mingomba. We want many, many more Mingombas, but we're also exploring for lithium around the world. We're looking in Namibia. We have a few licenses we acquired in southern Namibia, very early stage greenfield opportunities. We're looking in North America. We're looking in Australia. So we are not limited only to Zambia.
Where in North America are you looking in
Both Canada and the U.S.
Canada and the U.S.
Yes, that's right.
Do the current geopolitical tensions then potentially affect what those partnerships could look like?
No, I don't think so. I think the world realizes that we need these minerals to spur growth. The global North needs it for aging infrastructure. The global South needs it to industrialize. Africa needs it to industrialize with this fastest growing youth population. So the focus should be on that and not on the geopolitics.
Okay, so it's not going to affect the business. There's no concerns there, especially between U.S. and Canada and potentially what that could look like?
No, I don't think so. I mean, we're in exploration. So at this point, we're not producing anything. What we need to do is find these assets. When we start finding and making more discoveries, then we can start talking about how it's supplied around the world. But the reality is we're calling them critical minerals for a reason. There is a risk of not being able to supply. We need to make more discoveries. And that's where KoBold uses its cutting-edge technology with artificial intelligence. Industry hasn't done so well in the last 30 years. It takes 10 times the cost of failed projects to have one successful discovery. And we are leading by using technology to make discoveries much, much cheaper.
All right, we have to leave it there, unfortunately. It was great to get you on. That is the KoBold Africa CEO, Mfikeyi Makayi, joining us here at Mining Indaba. Paul, I'll send it back to you.
Thanks very much. And let's recap some of the breaking headlines coming out of China as President Trump's 10% tariffs took effect at the top of the hour. So China retaliating pretty much straight away. It's going to levy tax on some products imported on the US. So there'll be a 10% tariff on oil and agriculture machines imported from the US. China will also impose a 15% tariff on coal and LNG imported from the US. There will also be export control around tungsten-related materials, and also China is going to be we're seeing soybean prices expending losses as well. But take a look at some of these assets that we're seeing. A big slide in crude prices. Brent crude off by about 1%. New York crude off by 1.6% on that news. The offshore yuan also weakening. We're still some way short of that record low, 732.78. Interestingly, though, we're seeing the Aussie and Kiwi dollars as proxies for China getting hit even harder than the offshore yuan. More in a moment. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. A US tariff reprieve for Canada and Mexico pushes Asian markets higher. The two nations promising tougher measures on migration and drug trafficking in exchange for a 30-day delay on President Trump's 25% levies. Attention now turning, though, to China. We've had that 10% tariff come into force today. China retaliating very swiftly. We'll get to the details of that in a moment. Trump saying he might speak directly with President Xi. And Israeli Prime Minister Benjamin Netanyahu is set to meet with President Trump in Washington. And he's the first world leader to visit the White House since Trump's inauguration. Good morning. Just gone 4:30 p.m. in the afternoon here in Sydney. It's 9:30 a.m. across the Emirates. I'm Paul Allen.
And I'm Jennifer Zampasaja in Cape Town, where it's just gone past 7:30 a.m. I'm live here at the Africa Mining Indaba conference. It is day two. We're waiting for a lot to develop and a lot of conversations to start again, Paul. And of course, there are a lot of external factors that are happening outside of these walls here affecting some of the discussion. So it will be interesting to talk to more of our guests throughout the day.
Certainly will be, because we've seen commodity prices moving off the back of developments in the past 30 minutes. Of course, the deadline expiring for those US tariffs on China. So 10% tariff coming into effect, and China wasting no time in retaliating. As we've mentioned, there is going to be a 10% tariff from China on oil and agricultural machinery imported from the US, and a 15% tariff on coal and LNG imported from the US. So a whole lot of assets are moving. Let's start with the offshore yuan. That has weakened considerably, 732.43 at the moment. We're still some way short of the record low, which is 737.49. But the offshore yuan weakening immediately. Interestingly, though, not weakening as much as the Aussie and Kiwi dollar, which often trade as proxies for risk around China. Let's take a look at what else is moving as well. We're seeing a bit of softness in the oil price. We've got crude off by almost 1%. New York crude off by more than that. We're seeing copper moving lower as well. China not holding it back when it comes to retaliation, although, as we've seen with Mexico and Canada, things can change very quickly. So we'll keep an eye on the news flow. Keeping an eye on markets in Asia, meanwhile, we've got Avril Hong in Singapore. Avril, what sort of reaction are we seeing?
Yeah, it's really interesting. You talk about the reaction in the renminbi. We're seeing it session highs. The rest of the Asia Pacific, the major gauges mostly pairing the gains quite sharply. But look at how the Hang Seng Tech and Hang Seng are faring. It's really interesting and remarkable how it's managed to retain most of the gains from earlier in the day. And perhaps this speaks to the idea that, coming back to trade tomorrow, onshore markets, we might hear from Chinese authorities now that tariffs have been announced, come through with big bazooka-like stimulus for tech stocks in Hong Kong in particular. They also have the DeepSeek narrative going for them. But of course, there are still these risks lingering. The US-China trade war has begun. You noted there that retaliatory action, which I won't go into details of, but I thought I'd just highlight a point that MLife's Mark Cranfield has been making saying on the blog that the Chinese authorities' reaction in terms of retaliation, very telling in the sense that maybe they themselves don't see Trump backing down either. But for now, we're still seeing the Hang Seng managing to outperform in the region. Paul.
All right, Avril Hong in Singapore with the market reaction there. President Trump, meanwhile, is going to be meeting with Israeli Prime Minister Benjamin Netanyahu in the White House later this afternoon. Netanyahu, the first foreign leader to visit the US since Trump's return to the Oval Office. The two leaders are planning to discuss the Gaza ceasefire, but the president told reporters on Monday that he's got no guarantees that the peace is going to hold. For more on this, let's bring in Bloomberg's Dan Williams in Jerusalem. So, Dan, what's on the agenda? What topics are likely to be discussed?
Well, I think primarily, as you noted, there will be a public signal here of the intimacy, the trust between these allies. It's no accident that the Prime Minister, the Israeli Prime Minister, is the first foreign leader to be hosted by the newly re-elected Trump. Keep in mind, this timing isn't ideal for Netanyahu's health. He recently underwent surgery, but nonetheless, he went out to the United States in order to set that public message. Israel's main priority right now is to see which way the ceasefire in Gaza is heading. It's halfway through the first stage of the ceasefire. However, whether the ceasefire becomes protracted depends on what Israel, and to a large degree the United States, agree to in terms of Hamas's standing, Hamas being the enemy party in charge of Gaza. Israel says that any full ceasefire, any open-ended end of hostilities depends on Hamas no longer being in power. There's no indication Hamas is relinquishing power voluntarily. Netanyahu will want to hear what Trump's ideas are on this matter and how it might affect the wider Middle East.
So what's the likelihood that the Gaza ceasefire talks are going to guarantee the implementation of Phase 2?
Well, that's the thing. There's a big question mark over Phase 2 because what is left unsaid is the deal is what what rule Gaza would revert should there be a Phase 2. As I said, Israel wants no Hamas government there. It wants to fulfill its original war goals of dismantling Hamas as both a military and a governing force. And indeed, the fact that during Phase 1 so far, a number of Israeli hostages have, according to plan, according to the agreement, gone free. But there's really been a good degree of grandstanding by Hamas, shows of force, men in uniform, guns, etc., would really stick in the craw of Israelis and remind them that Hamas is still a force to be reckoned with. So Israel will be saying to the Americans, we do want to go ahead, but we do have this obligation to our citizens, to ourselves, not to do so with Hamas staying in power. The big question is whether that can be achieved without a return to war. Israel has said publicly it's willing to return to war. The United States may not be so willing to see that. Trump is not a president who is especially keen on wars, open-ended wars he might regard as wasteful.
All right, Bloomberg's Dan Williams in Jerusalem. Thank you. Jen.
Yeah. So Anglo American's chief executive says President Trump's new tariffs will increase the cost of mining production for years. The warning comes as an international trade war threatens to upend the flow of commodities. So joining us now here at the Mining Indaba conference is Rohitesh Dhawan. He is the president and CEO of the International Council on Mining and Metals. Rohitesh, great to get you on, especially on a day like today. We were just talking about the China-U.S. trade war starting, right, effectively. I wonder from your perspective, where you sit, have you been surprised to see some of the moves, at least in the commodities that we're seeing, even at this point in time?
Well, Jennifer, gold is up nearly 6.5% during the course of January, and its average price over the course of January was an all-time high. That's reflective of the tensions we're seeing and the uncertainty, given that a commodity like gold is both a hedge against inflation and against uncertainty, and tariffs are likely to increase inflation across the economy, particularly in the US. But I have to say, Jennifer, we are not strangers to uncertainty and disruption in the mining industry. These kinds of disruptions geopolitically are things that the industry has had to deal with over decades. And so while it's uncomfortable in the short term, I'm confident that the industry will be able to ride it through.
But how would you characterize this? Because we really haven't seen something to this extent, at least in the past few years, right? I mean, how would you characterize this from a mining perspective?
It's yet another factor that's going to make it harder to build new mines that are required for the energy transition.
Okay.
Already, it is one of the most challenging environments in which to build a new mine. Cost pressures have been rising over the last few years. Permits take very long. Local community support is often a challenge. So when you then throw in additional geopolitical uncertainty, the main impact that it's going to have is to make it more challenging to open new mines. And that matters to everybody, not just to us in the mining industry, because new mines are what's needed to supply the world with the metals and minerals that go into electric vehicles and renewable energy technologies.
And your organization is made up of a number of CEOs of some, I mean, the biggest majors really in the mining industry. What is that concern there then? I mean, does that mean their revenues start to fall short? When they talk about some of the pushback, I guess, in timelines, what does that look like for them?
It looks like delays in projects getting online, which of course has a knock-on impact on both revenues, your capital expenditure, the returns you're able to provide, not just to shareholders, but to governments. And here, Jennifer, it's important to keep in mind that these companies are often the backbone of many national economies. So it's not just a direct impact on us as an industry, it's then the flow through into the rest of the economies. We just released, for instance, the taxes that we paid over the course of the last year, and it showed that we paid $42 billion in taxes to governments around the world, which was approximately 40% of our profits. So when our profits go down, as they did in the course of the last year because of lower commodity prices, the tax take also goes down for national governments. However, I'm also really pleased to say that even though the number was lower in 2024, the percentage that we paid across as taxes was significantly higher than prior years.
What does that mean then for African host countries, right? I mean, this conference is about future-proofing the industry for African miners. I mean, what does that look like then?
It looks like an ability to support an industry that can provide stable, predictable returns for economies that are trying to grow and develop at a pace to take people out of poverty and to modernize economies. And you can't think of many other sectors that can give you that broad base of development. Here in South Africa, for example, the mining industry contributes nearly half of all commodity exports that the country makes, 6% of GDP. And you'll see similar numbers and even higher numbers in many other African economies. And so if we can come together in a partnership form that allows for the industry to develop in a way that also allows for people to develop, it gives African economies a blueprint for future-proofing themselves. Because keep in mind, not only are they trying to grow and develop, they're trying to do that in a climate-stressed world, where a backbone of development becomes even more important.
Well, part of that is the tension, though, right? I mean, you look at what's happening in West Africa with Barrick Gold. So how do you reframe or rethink some of these agreements for the years to come?
The way to rethink them is to avoid looking at them as a zero-sum game, where if the industry wins, then the government loses, or if the government wins, then the industry loses. Unfortunately, that's where the conversation has ended up. And I think we need to take it out of there to say, what can we do that makes everybody win and grows the pie for everyone?
Is it possible, though? Because some of these companies have been invested for years, right? I mean, how does that work?
Some of the richest economies in the world, the most stable economies in the world, have been built off the back of mineral wealth. Take Australia, Canada, even Chile in South America. So yes, we have examples, Botswana here in Africa. And just recently there was an agreement concluded that will ensure stability for Botswana's mines in the coming years. It's absolutely possible. It takes creativity, imagination, integrity on both sides, the private sector and governments. And it's not just Mali that you reference, it's also Niger and other countries in West and North Africa that are starting to act in ways that are unpredictable and in ways that are making it very difficult for miners to make the long-term investments that can then be the basis of these win-win partnerships.
But are those disagreements justified?
It varies country by country.
Yeah.
What's most important is that dialogue should never stop. And when things get really bad is when both sides stop talking, either because there's been the kinds of actions we've seen around arresting of executives, which really does create a problem for dialogue, or where mines have to shut down operations because it's no longer feasible to operate in that country, like has been the case in Niger. So I would say almost every disagreement is resolvable as long as we keep dialogue open.
All right, and that is part of what's happening here at Mining Indaba. We have to leave it there. Rohitesh Dhawan, President and CEO of the International Council on Mining and Metals, joining us here at African Mining Indaba. Now, coming up, the EU says it's ready to react to potential Trump tariffs. We're live from the port of Hamburg, the third largest in Europe, for special coverage of the global trade fallout. Stick with us. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. We're just getting some breaking news on the terminal. It is earnings from UBS reporting a beat, net income $770 million US. That reverses the loss that we saw on year earlier of $279 million. Total revenue coming in at just a shade over $11.6 billion. That was an increase of 7.2% on year, and it also beats the average analyst estimate. Net interest income $1.84 billion. That was a 12% contraction on year, but and a little bit short of estimates. Operating expenses $10.36 billion. That was also a little bit short on estimates, but the headline figure was a beat, and UBS returning to profit. You see there also on your screen that it's planning a $3 billion buyback in 2025. That is, however, subject to Swiss regulation. Well, EU leaders, including Germany's Olaf Scholz, have vowed to retaliate should President Trump impose tariffs on the bloc. We've got special coverage of the global trade fallout and what it's going to mean for Germany, which is, of course, the EU's largest economy, and it's heading to the polls in just a few weeks' time. Bloomberg's Oliver Crook is live with us from the port of Hamburg, which is the largest port in Germany. So, Oliver, how's the threat of US tariffs playing out in the region?
I mean, yeah, listen, Paul, I mean, this sort of looms very, very large over all of Europe, obviously, but principally over Germany, whereas, you know, the sort of largest exporter of the EU and was really actually the largest exporter in the world until it was overtaken by China in 2010. And it's been fundamental to the sort of German growth story over the last several decades. It has been the great generator of wealth for many, many years here in Germany. And what we have found is an economy that has been slowing year after year and whose competitiveness has been considerably challenged. And of course, the last thing that Germany needs right now, after having just announced another year of contraction, in part due because of the sort of difficulties in trade, is additional trade threats from Donald Trump. And so we're here in the port of Hamburg, the biggest one here in Germany. You know, 90% of global trade is conducted over the waterways. And I spoke to the CEO yesterday of Hapag-Lloyd, which is the company, the shipping company that moves about 10% of those cargoes across the world, the fifth biggest in the world, about basically what this Trump threat means for obviously for the company, but also for global trade. Have a listen to what he had to say.
I think in the end, the effects on global trade will probably be somewhat limited. I think especially the 10% on China will not do all that much, also because we've seen a recent appreciation of the US dollar anyway, compared to many currencies. So short term, I don't expect to see a lot of effects from that, but longer term, of course, tariffs are never good for global trade.
Delay of a number of those tariffs, that's obviously a large amount of reprieve for many of these shipping companies and really sort of these economies across the world. But again, the EU still has not had its negotiation, and Trump has vowed to, you know, impose 10% tariffs. It's not clear exactly what he's going to ask to extract from them. But let's not forget, these 10% tariffs on China also move forward. This has implications for Europe. While there are some good aspects to it for Europe, for example, if some of that LNG is more expensive for China to buy from the United States, maybe some of those cargoes come here to Europe, and that is really what Trump wants to see, the Europeans buying more fossil fuels. But it, of course, will threaten even further European competitiveness, because it will mean more cheaper goods coming in from China, which is one of the principal issues that the European economy is grappling with and what this new commission in Brussels also wants to attack.
Yeah, well, there's another factor as well. Of course, Germans heading to the polls in a few weeks. What's the latest on the campaign trail?
Yeah, I mean, it's been a very sort of tumultuous few days in the German campaign trail for the election here. After on Friday, for the very first time since the Second World War, one of the mainstream parties in Germany, the CDU, the leading party, basically voted in the same direction as the AfD, the extreme right. This caused a huge amount of controversy within Germany. There were a huge number of protests, tens of thousands of people. Even here in Hamburg, there were tens of thousands of people taking to the streets to really object to this. What I have found very interesting is that despite this, and by the way, they voted together together, and it was still not enough to get this piece of anti-immigration legislation over the line. This has not really dented the frontrunners in the polls so far. He's still holding at about 30%. The CDU, Frederick Merz, still leading, and really his ambition now is to move away from this focus about this vote that happened on Friday and more towards the economy, coming back to things like global trade, coming back to trying to bring the prices down, trying to make you feel your sort of day-to-day issues, like being able to sort of really feel the sort of wages that you're generating and sort of dealing with the cost of living crisis. And that is going to be the main thing that he's going to push forward. And with it, again, also detracting to some of the sort of green policies that we've seen from the last government.
All right, Bloomberg's Oliver Crook at the Port of Hamburg. Thanks for joining us. Still to come, M23 rebels in the DRC declare a unilateral ceasefire as African leaders agree to hold crisis talks. Details next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town. Now, M23 rebels in the Democratic Republic of Congo have declared a unilateral ceasefire for humanitarian reasons. That's as G7 nations demanded the Rwanda-backed militia halt an offensive that has shaken the eastern part of the country. The UN says at least 900 people were killed in Goma during the assault. Let's get more from Bloomberg's Ndiro Oganga, who is joining us in Kigali. So, Ndiro, what can we expect following the ceasefire announcement? And the big question is it actually expected to hold this time around?
Hi, Jen. So what we can expect is M23 is expected to cease its offense on the southern part of Kivu. And they said in a statement that they have no intention of capturing Bukavu. Instead, they're going to protect their position and they're going to protect civilians. They're also calling for the withdrawal of Sami DRC, saying that their mandate is no longer justified. And this ceasefire comes at a critical time because the humanitarian situation in Goma is worsening. A city of 2 million people in dire need of water, food, fuel, and medical supplies. And the UN fears that there's heightened risk of disease outbreaks such as cholera, mpox, and measles. And in the intro, you mentioned 900 dead. These are people that were killed in the streets without factoring in the bodies that are lying in the morgues. 2,800 have been injured, and hospitals have been overrun. So the ceasefire lays really good groundwork for the summit that is to be held in Tanzania between heads of state from EAC and SADC. And DRC's President Felix Tshisekedi has confirmed that he'll be attending, unlike last time where he was a no-show, and promised to fight back, much to the frustration of his Rwandan counterpart, who's always maintained that Rwanda is not supporting M23 rebels. But when CNN tasked him to explain if there are Rwandan troops in DRC, he said he didn't know. He opted to shift blame and say the people that are stealing minerals in DRC are South Africa. And this assertion is expected to cause tension after we saw a diplomatic spat between the two African countries in the previous meeting.
All right, Bloomberg's Ndiro Oganga in Kigali there. Thank you. Right, let's take a look at assets that are moving. The story of the hour, of course, that 10% US tariff hike on China becomes effective. The deadline lapses. And China responded immediately with 15% levies on US coal and LNG, also a 10% tariff on oil, agricultural equipment. Other moves as well, an investigation into Google, export controls on tungsten-related materials, and look at the movement that we've seen. S&P futures had been in positive territory. Now we see they're slipping backwards. NASDAQ futures slipping as well on the news of that antitrust probe into Google by China. We've got Euro Stocks futures also looking a little bit softer as well. So China imposing a series of countermeasures against those 10% US tariffs. We've also got a weaker oil price as well. We've seen crude softening off the back of that as well. We've also got cryptocurrencies moving, also risk assets slipping backwards on that news, and the offshore yuan weakening also, but still some way short of that record low. Well, that is it for Horizons Middle East and Africa. I am Paul Allen with Jennifer Zabasaja in Cape Town. Stay with us for Daybreak Europe. This is Bloomberg.